Have you ever looked up at the sky and wondered, what if you knew more about macro? Well, then you're in luck, because this video, we're going to go over some of the basics, some of the fundamentals of macro. We're going to explore the liquidity in the business cycle. We're also going to tie in how central banks affect both of these cycles. In my opinion, these are two of the most consequential components of macro and Web3 that you can understand to make sense of the data that is out there and be a better investor and position yourself on the right side of market risk. So if that sounds exciting to you, like and subscribe down below, and let's hop in to the first in our educational series. Now guys, in this video, we're going to break down the two main cycles that I think are some of the most consequential aspects of what drive crypto and overall market cycles, the liquidity and the business cycle. So let's start out with the liquidity cycle. It's something we are all familiar with. Liquidity is essentially the amount of money or credit in the financial system able to use to be refinancing debts, to be purchasing risk assets, etc. And it comes in cycles. As you can see, starting back from 1965 on this chart, the global liquidity cycle is a 4 to 5 year ebb and flow of liquidity coming into and out of markets. Every country has its own liquidity cycles. You can see here the US has their own. And you can think of this really just as the pace of debt refinancing. And so really liquidity cycles. The reason that central banks put in liquidity into markets, the reason they pull it out is to manage inflation and to refinance debt. And so debt really is what drives the world. When a sovereign nation has a bunch of debt that they have to pay off, somebody somewhere needs to have the money to take on that debt. Someone has to have money for it. You can't just throw debt out into the world and have it work. So basically what happens is that people come in, they buy the debt. What people cannot take on, the central banks buy, because that's the main goal of the central bank really, is to help make this debt manageable. So they control the world's money supply. They control each sovereign nation's money supply. And then they can put money into markets, they can pull money out to manage inflation, to manage labor market, and primarily to settle debt. And so you can see that here in this chart. This is from Raoul Paul, Julian Biddle over at Real Vision. We're going to be using a lot of their charts today. Definitely check them out. There's some of the best in these two things. The liquidity and the business cycle. So you can see here really since 2008, you can see that central banks push in money and they pull out money. This is debt refinancing, all of this. This is the Fed. The People's Bank of China, the Bank of Japan, the European Central Bank, the Bank of England, refinancing debt. It all comes down to debt. And so that's what drives the 4-year cycle is debt refinancing. Global debt termed out around 4.5 years. And so we get these roughly 4.5 year cycles where liquidity comes into and comes out of markets. And so as more liquidity comes into the system, risk assets go higher. This is because currency is getting debased. And I want you to look at this picture on your screen here, and this is really going to help you put this into perspective. So sometimes the best explanations are the simplest. What seems to be happening, dollars remain flat, a dollar is worth a dollar is worth a dollar, and Bitcoin's going higher. What is actually happening is Bitcoin is remaining flat because a Bitcoin is worth 1 Bitcoin because there's 21 million and no more ever. And the dollars are becoming worth less. That is the essence, because as the amount of money in the system goes higher, those dollars, those fiat currencies, yen, yuan, pesos, whatever it is, they become worth less. Think of it like Charizard cards. Think of it as all the perfect 10 out of 10 PSA first edition Charizard cards. Think about how many of there are in the world. Probably not many. That's what makes them scarce. Imagine if tomorrow somebody found 10,000 perfect 10 out of 10 minted, graded, in the perfect box Charizard card. What would happen to the value of Charizard cards? They'd probably go down because this guy's going to start kicking out perfect Charizard cards left and right. That is what's happening to the US dollar. And that is what's happening to the Japanese yen, into the Chinese yuan, into the English pound, British pound, whatever. That is why assets go higher as liquidity comes into the system. And we can see that demonstrated here. As global liquidity goes higher, Bitcoin also goes higher because Bitcoin can price this in. Bitcoin is a stable representation of absolute scarcity that cannot be replicated. There will only be 21 million. It can price in that currency debasement. It can price in this. This goes down against something that does not get debased. So that's one of the primary functions of why liquidity makes assets go higher. A quick lesson in currency debasement. And really, you can see it here in this chart. S&P S&P 500 returns with and without inflation, with and without money printing, with and without currency debasement, 600% without inflation, 6,500% with inflation. What does that tell you? Inflation is the main driver of asset prices. So as central banks inject money into markets excessively, assets go higher because they're pricing in that debasement. They're pricing it in. The risk assets, Bitcoin and Ethereum and houses, which is not a risk asset, obviously, and stocks go higher as currency becomes worth less because it takes more of these devalued units of currency to buy this thing that has not changed in value particularly very much. Some things, yes, Nvidia stock, Bitcoin is valuable because the network is proliferating and it's strengthening and there's Metcalfe's law and all of that. But primary driver of asset prices is inflation and currency debasement. And this is what drives it. And so every 4 years, the debt comes due. Central banks pour money into markets and assets go higher as a result. They print money because we spend more than we earn in tax. So we make the difference up through printing money. And so that is really the essence of why global liquidity makes assets go higher. And central banks do this over a period of time. And they will find ways to do it. And I want to show you this chart. This is from Mike Howell over at Cross Border Capital. Awesome Substack. Definitely check him out. Godfather of liquidity. They will find ways to get this in. Treasury QE, where the Treasury issues debt and private banks buy it. Regular QE, where the central bank prints money and buys bonds. Not QE. I don't even know what that is. But they just find another sneaky way. There's always little sneaky ways that they'll find ways to get money into the system to buy back debt. And then you can see this is the bear market. And where we are right now is we are still recovering from the hangover that happened here. All the COVID printing that happened here. So this is, I think, why, and you can look back at our 4-year video, why I think the 4-year cycle is dead. And it's been extended essentially is because of this massive inflation. If you remember your grocery bills in 2020, if you remember your grocery bills here, and now you remember your grocery bills over here, they're a lot higher over here. After all of this debasement, after all this money printing, this is the bull market right here. So if we can understand that roughly every 4 to 5 years, central banks inject liquidity into system, they lower interest rates to pay less interest on that debt that they're issuing, we can essentially understand when assets will catch that inflation, that currency debasement move higher. And you can see it here another way. I mean, this really shows it. Going back since 2008. 2008, we go higher, we come down 2012. Here's the bear market. We keep going, we go higher, we go higher. We come down around 2016. This was the 2017 bull market where the Fed was actually not buying any bonds. We were actually tightening here. But, who was doing a lot of printing was China. And we have that here. You can see that in 2017, they're printing a lot of money up here. They're going a lot higher. And so you can see the connection here between Chinese liquidity and world commodity prices. Naturally, the Federal Reserve, the pillar of liquidity in the West, and then the People's Bank of China, the pillar of liquidity in the East, are the two most consequential central banks. When they print money, assets go higher because they're printing a lot of money. And so one last little tidbit I want to give you before we wrap up this liquidity section is the difference between global liquidity and M2. I see this all the time. M2 Bitcoin, M2 Bitcoin, M2 Bitcoin. It's not a one-for-one correlation, first of all. I just want to put your minds at ease. Sometimes there will be a deviation. It doesn't mean that it's all broken. Because now that we understand that currency debasement drives assets higher, we understand that there really can't be a break. As global liquidity, as M2 goes higher, Bitcoin will follow it because it prices that in. It can price in that currency debasement. It takes more of these lesser value Charizard cards to get this one thing over here that has maintained its scarcity. Liquidity, though, is different from M2 in that it also accounts for credit. And credit is a big source of liquidity. World M2 does not account for credit. M2 accounts for any number of things. It's not really important. It's not really important to know this either, to be honest, but you can just flex on your friends. And I think that's kind of cool. Someone says, oh, M2 is going higher. You can be like, well, technically global liquidity is actually a true measure, of inflation. No big deal. Give them one of these. What are you going to do? So I hope this gives you a better understanding of the liquidity cycle, what it is, why it matters, and really more of a crash course as well in currency debasement and how that functions as well. So another half of this core understanding of risk asset cycles, it is the business cycle, which is essentially the expansion and the contraction of economies, resulting in a broadening out of asset allocation Large caps down to mid caps, small caps, micro caps. That's alt season. In the equity verse, they call that a broadening out. How do we understand the business cycle? We understand the business cycle through what's called the ISM. And I'll show them. It stands for the Institute for Supply Management. It's a survey they give to the world's largest supply chain managers, and they ask them a series of questions about their business, ask them how their outlook is for the economy, for new orders, new hirings, a bunch of questions. Based on those scores, they ask it to a bunch of people. Based on those scores, they get a number roughly between 40 and 65. Below 50 means that the economy is contracting. Above 50 means the economy is expanding. And so that's how we understand whether the economy is accelerating or decelerating. You can see the strong connection to altcoins here. And this is really something that tells me, and we go over this in the 4-year cycle video, that altcoins are not finished moving, at least as long as we see the ISM go higher. And I do believe we will see the ISM go higher. We've been having business cycles for quite a long time. Going back to 1985, you can see that there is a ebb and a flow to the business cycle. Just as liquidity expands and contracts, the business cycle also expands and contracts. And it kind of roughly follows that cadence of debt refinancing because they're all kind of connected, all of these things. It's how economies work. And so you can see that this here shows the connection to central banks cutting rates. Central banks also play a very big role in the business cycle because as central banks cut rates, allow liquidity to flow more freely, as they encourage risk-on behavior, the economy expands. People get excited. People have more work. People have more jobs. People have more hours because it's easier to get money. It's easier to take risk. And it's generally it's time for an expansion. That is the business cycle. And so understanding where the ISM is very important to understanding where we are in the risk asset cycle. And so one of the ways we can forecast the ISM or kind of think of where it's going to be going is by understanding financial conditions. Financial conditions you can think of as a number of things. How strong is the dollar, the DXY? Is the dollar falling or rising in price? Is oil falling or rising in price? Is the central bank cutting rates? Central bank rate cuts is an easing of financial conditions. Stock prices. If stock prices are going higher, financial conditions are getting easier. And so these things essentially forecast where the economy is going to be going. And you can see the connection here. This is taking us back to the end of the last bull market. Financial conditions projected to go lower. Look at where altcoins were during that point of time. 70% of Bitcoin's total market cap. And then financial conditions fell. The dollar started to go higher. The central bank started hiking rates or signaling they were going to hike rates. Maybe oil started to go higher. Maybe stock prices started to sell off. Financial conditions tightened. And what happened? We fell right along with it. The ISM fell right along with it. And what did altcoins do? They fell right along with that. This is a very good indicator, and it always has been, of when small caps are going to catch a bid. Because it's essentially a wellness check on how we're all doing, how average people are doing. If the economy is accelerating and the central bank is allowing people to borrow money more freely, then small and medium-sized businesses are doing well. People have more jobs. They have more money, they feel better about their finances, and hence they're able to go into riskier assets. And I believe that there's probably a connection, although it's not written down anywhere, that the market makers and the big manipulators out there understand that. And they say, okay, now's the time to start rallying smaller assets so that retail can come in, there's our exit liquidity, and then people get wrecked. Because they're not understanding how the ISM functions. They're not understanding how financial conditions can help them predict this move. You can front run these institutions. These institutions have a very set guidance of rules they need to follow. You're your own agent. You're a free agent. You can do whatever you want. These people are kind of restricted in this sense. If you're paying attention to short-term rates, if you're paying attention to the price of oil, the DXY, paying attention to stock prices, you can essentially forecast where the ISM is going to go. You can essentially forecast where altcoins are going to go. You can forecast where Ethereum is going to go. And then you can also understand where Bitcoin dominance is going to go. And this helps you perform better in the crypto markets. I feel like this is good information to have. So for me personally, I can't tell you when alts are going to make their move, but I can tell you with reasonable certainty that the ISM will go higher again, especially as we're seeing the central bank starting to cut rates, the Fed cutting rates, as we're seeing the DXY breaking down, as we're seeing oil fall in price, as we're seeing stocks go higher, we're seeing financial conditions ease, and hence the ISM will go higher. So I'm positioned right now. I'm positioned and I'm sleeping soundly at night because I say to myself, are the chances good? Are the chances good based on all this data from 1985 that altcoins will go higher at some point? Yes. And that is the purpose of this channel is not to tell you when, is not to tell you what to do, but to tell you that the data that is available to us and the historical precedents that have been set tell us that at some point a move higher is coming, to give you the conviction to sit through volatility and wait for euphoria and sell into that. And I will be on this channel screaming at you to sell when the time comes. That time is not right now. I don't believe that it is. I don't have a crystal ball. I wish that I did. Have an amazing channel if I did, but I don't. Where do we go from here? How do we take all this information and digest it? We say to ourselves, I'm understanding that there's a pattern of liquidity coming into markets from central banks to refinance debt. This has to happen. I'm understanding that economies expand and contract in a relatively forecastable cadence that is forecasted by financial conditions, a series of things. It's also forecasted by other things such as GDP, which is forecasted by CapEx, but that's for another video. We can't give away all the goodies in one video. So if I can roughly understand where the ISM is going, then I probably have a good idea of where small caps are going. The Russell 2000, altcoins, Ethereum, Bitcoin dominance, whatever you want to call it, it all represents the same thing, a broadening out of assets from high caps down to low caps, which is where I reside, and chances are that is where you reside. So I hope this has been helpful. I hope this is enlightening for you. I hope that this is something you can look back to in the future and say, I'm going to listen to that video and learn a little bit more, get a little more familiar. You can use these tips and tricks, use these charts, use this information to become better, more confident investors. The goal is to sit through volatility, which is often the hardest part of crypto, and make it to the other side. We'll be a bunch of real life Andy Dufresnes. Anyways, that's the video. I hope you found it informative. If you've learned anything, leave a comment down below, like and subscribe to the channel. We appreciate you being here. We'll see you in the next educational series.